The challenge of transforming financial regulatory reporting from disconnected documents into open and standardized data requires the leadership of many different constituencies. It requires Congress to lead, as we saw this morning when Congressman Issa announced new legislation that will bring about open data throughout financial regulatory reporting. It requires industry to take notice and to deliver the platforms and the solutions that will republish, that will analyze, that will automate the information once it is expressed as data. But most of all, this transformation requires leadership in the executive branch. And we're very excited that this afternoon we'll have the chance, as part of our afternoon keynote, to hear from Dick Berner, the first director of the Office of Financial Research at Treasury, the only entity that truly has an enterprise-wide view of financial regulatory reporting across all of our alphabet soup of regulators. The leadership of the OFR, first foundationally in adopting the legal entity identifier across different agencies, and soon in other areas as well, is foundational in the transformation that we're exploring today. We're grateful for the support of all of our sponsors, and right now I'm excited to welcome Bryce Pippert, a principal at Booz Allen Hamilton, to introduce the director. Please help me welcome Bryce.
Thanks, Hudson. Always great to be here and with you. Pleased to be introducing our next speaker. So this morning we heard about new legislation that's coming, the Madoff Act, which will impose new requirements for disclosures by our financial regulators here in the US, which will make additional data sets available for analytics and for better oversight of our financial markets. We also heard from Tony Scott about the more than $1 trillion of value that's locked up in data sets. Data is clearly an asset to be managed and leveraged to support the missions of our organizations and to unlock efficiency, innovation, and economic growth. Our speaker this afternoon is focused on data to manage risk to our financial system. This afternoon's keynote speaker is Dr. Dick Berner, Director of the Treasury's Office of Financial Research. He has been in the middle of figuring out how to use data and standards to help to identify and manage systemic financial risks in the US. Dr. Berner joined the Treasury in 2011 to stand up the Office of Financial Research as required by Dodd-Frank. Prior to joining the Treasury, he was the co-head of global economics at Morgan Stanley, and he also served as chief economist for Mellon Bank. He has been an adjunct professor of economics at Carnegie Mellon and George Washington University. Director Berner has been a member of the Economic Advisory Panel of the Federal Reserve Bank of New York, the Panel of Economic Advisors of the Congressional Budget Office, the Executive Committee and Board of Directors of the National Bureau of Economic Research, and the Advisory Committee of the Bureau of Economic Analysis. Dr. Berner has won multiple economic forecasting awards and was awarded the 2007 William Butler Award for Excellence in Business Economics. Director Berner received his bachelor's degree from Harvard and PhD from the University of Pennsylvania. As the head of OFR today, Director Berner is focused on identifying risk to the systemic financial stability in support of the Financial Stability Oversight Council by collecting data, standardizing data, and performing research. OFR's mission depends upon good, timely data, and Director Berner has been critical to pushing global standards such as the Legal Entity Identifier to help to achieve that mission. OFR recently launched financialresearch.gov to make OFR's work more transparent and more accessible to the public, Congress, and the Financial Stability Oversight Council. Please join me in welcoming Director of the Treasury's Office of Financial Research, Dick Berner.
Thank you, Bryce, for that kind introduction. Good afternoon, everybody. It's really a pleasure to be here, and I want to thank Hudson for his leadership of the Data Transparency Coalition and the Coalition for sponsoring this important summit and for inviting me here to discuss how standards can improve financial data and thus transparency. As you all know, developing and promoting standards for financial data are central to the mission of the Office of Financial Research. Likewise, I know that financial data standards are important to everybody in this room, and I appreciate your interest in and support for their use now and in the future. Today, I want to focus on the OFR's data standards agenda, past, present, and future. Related, I'll discuss how we at the OFR are meeting the critical needs to share data and to fill data gaps. As I'm sure you know, the OFR was created by Dodd-Frank in 2010 to help promote financial stability by delivering high-quality financial data and analysis, as Bryce just mentioned, for the benefit of the Financial Stability Oversight Council, or FSOC, as it's commonly referred to, and the public. Now, financial stability monitoring, analysis, and research certainly are not new, but the financial crisis that began in 2007 changed the conversation. The crisis exposed critical gaps in our analysis and our understanding of the financial system, in the data and metrics used to measure and monitor financial activities, and in the policy tools available to mitigate potential threats to financial stability. These gaps in analysis, data, and policy tools contributed to the crisis, and they hampered efforts to contain it. These gaps are interconnected like links in a chain. Weakness in any one of these three links could impair our overall ability to spot and to address weaknesses in the financial system. We need good analysis to make good policy, and we need good data, solid, reliable, granular, timely, and comprehensive data to conduct good analysis and monitoring. In other words, good data are the foundation for success in our work and for effective risk management in financial companies. Now, it may seem obvious to all of you in this room, but I can't overemphasize the importance of quality in making financial data usable and transparent. When Lehman Brothers failed more than 6 years ago, its counterparties could not assess their total exposures to Lehman. Financial regulators were also in the dark because there were no industry-wide standards for identifying and linking financial data representing entities or instruments. Standards are needed to produce high-quality data. I know the people in the next room are all in agreement with that. Transparency follows from quality. For data, transparency means that all users understand what the data represent. Fortunately, we've made some progress in improving both the scope and quality of financial data. However, gaps persist, and it's our job to fill them. The Global Legal Entity Identifier, or LEI, as I'm sure you know, is the cornerstone for financial data standards. As you know, the LEI is like a barcode for precisely identifying parties to financial transactions. The OFR has led the Global LEI initiative from the start, and it has gone from conception to nearly full-fledged operational system in just a few years by the standards of financial rulemaking and spreading these things through the financial regulatory community. This is lightning speed. Currently, the OFR's chief counsel, who is here this morning, Matt Reed, serves as chair of the Regulatory Oversight Committee, which oversees the LEI system. Now, I don't have to tell this audience that the case for ubiquitous adoption of this data standard is strong. Had the LEI system been in place in 2008, the industry, regulators, and policymakers would have been better able to trace Lehman's exposures and connections across the financial system. The LEI system also generates efficiencies for financial companies in internal reporting and in collecting, cleaning, and aggregating data. In addition, I expect it will ease companies' regulatory reporting burdens by reducing and eventually eliminating, we hope, overlap and duplication. The financial services industry, therefore, has strongly supported the LEI initiative. In fact, major trade groups have called for government regulators to mandate its use, a rare example of industry asking for more, not less, regulation. Now, the global LEI system is up, it's running, and it's growing. Like any network, the LEI system has benefits that will grow as the system grows. To accelerate adoption, the OFR has been calling for regulators to require broader use of the LEI in regulatory reporting. We are also calling for broad adoption of standards for instruments and products as they become available. Regulators have begun to respond. The Securities and Exchange Commission required the use of the LEI in rules announced a month ago for reporting data related to securities-based swaps. Last week, the Federal Reserve Board announced a proposal to require banking organizations to include their existing LEIs on certain regulatory reporting forms. I don't have to dwell on how these data standards can help you, your companies, and your agencies. But I would like to outline what you can do to help us all realize their full benefits. In particular, we'd like to call on you in the Data Transparency Coalition as a collaborator in pursuing data standards. That would be appropriate given your past work in helping regulatory agencies understand, use, and benefit from more effective use of data standards, in particular XBRL. And as you know, the Federal Deposit Insurance Corporation adopted XBRL as the data standard for commercial bank financial statement reports, most often referred to as call reports. Although this project has streamlined the call report process by reducing errors, cutting processing times, decreasing costs for banks, and improving the comparability of the data, different federal agencies are using different standards for identifying entities in XBRL data. The lack of a common standard limits XBRL reporting efficiency and raises costs. Adopting the LEI for the entity identification across agencies would improve efficiency and the quality of the reported data. The time has come to do just that, and we'd like your support for it. At the OFR, we recognize that the LEI is a critical and foundational data standard, but we also recognize that it's only the start, and there is much more to be done. On that foundation, we're helping to build other standards, and that's where we also need your help and your support. The LEI gives us insight into who is who among legal entities. The second standard can help us identify who owns whom, a standard for hierarchies or corporate structures, for easily identifying firms' subsidiaries and their relationship one to the other. This standard promises to help us make continued progress in tracing the interconnections in the financial system. The OFR is also working on a spectrum of other identifiers to help us answer the question, who owns what? Over the past year, we've begun to develop plans for a reference database for financial instruments, something that we're required to do by law. We do not want to start from scratch. On the contrary, we want to leverage work already done by others. For example, private firms, nonprofits, and academics offer products for instrument identification and analytics. We don't want to compete with them. We want to include them in the design so their systems can talk to each other. The reference database would thus connect these components together. We expect that as we further develop our plans for this reference database, we will consult with interested parties and invite comments on how best to take advantage of existing work while providing a coherent, system-wide reference. We thus expect this initiative to result in new opportunities for collaboration, for research, and innovation across the financial system. One example of the system-wide approach to data quality improvement lies in derivatives markets. Financial reform sought to improve transparency in derivatives markets by requiring that data related to transactions and swaps be reported to swap data repositories. As you know, swap data are critical to understand exposures and connections across the financial system, and the repositories are designed to be high-quality, low-cost data collection points. We at the OFR and our colleagues at the Commodity Futures Trading Commission, or CFTC, both want to promote the use of data standards and swap data reporting to assure data quality and utility. A year ago, we began a joint project to enhance the quality, the types, the formats of data collected from registered swap data repositories. Together, we're aggressively moving forward to address key data quality issues and inconsistencies in how data are reported across these SDRs. We're also collaborating on developing uniform global unique transaction identifiers and unique product identifiers. OFR collaboration on data standards includes not only U.S. regulators, but also regulators abroad. We view the international cooperation behind the LEI as a blueprint for further progress on other global financial data standards. For example, the OFR joined with the Bank of England and the European Central Bank in mid-January to convene a forum entitled Setting Global Standards for Granular Data, the first of 2 workshops. Discussions in this workshop built on our work with the CFTC and on work by the Committee on Payments and Market Infrastructures, or CPMI, the International Organization of Securities Commissions, or IOSCO, and the Financial Stability Board, FSB. How many acronyms can we rattle off there? To identify core standards needed to share and use data on over-the-counter swaps on a global basis. Data standardization is essential but not sufficient to improve the quality of financial data, to reduce or eliminate duplication, and to carry out our work. We also need to improve ways to securely share sensitive data, both among authorities within the same jurisdiction and across borders. Data sharing is essential because none of us, no regulator or company alone, possesses or has access to all of the data needed to paint a complete picture of threats to financial stability. The financial system is complex and ever-changing, so even if we put all of our data together in one place, significant gaps would remain and new ones would obviously emerge. It's a puzzle with many interlocking types and pieces of data. Now, a perfect understanding of how to fill those gaps will always elude us. But by working together, we can fill many of them. Your companies and agencies hold some of those puzzle pieces. It's essential for us to collaborate appropriately to put them together, to see where the gaps in data are, and to fill them. Equally, sharing is critical for the regulatory community to reduce duplication and overlaps in data collection. Now, you may be thinking that's easier said than done. Anyone who is familiar with this town can probably testify to that. We all realize that our goals of sharing and standardizing financial data across the globe face hurdles, including legal barriers, data security concerns, and confidentiality restrictions. These challenges are legitimate and they're potentially daunting. But we don't want to risk the potential consequences if future shocks were to trigger another crisis, simply because we lack the benefit of high-quality data to illuminate financial system vulnerabilities and possible ways to mitigate them. We believe that the efforts that are underway nationally and internationally demonstrate that with collaboration, we can make critical information available to decision makers while finding ways to secure the information, protect confidentiality, and honor legal requirements. For example, the recent report from the Irving Fisher Committee on Central Bank Statistics contains an excellent summary of recommendations and best practices in that regard. As I noted, the critical need to maintain the security of confidential data is an obstacle to data sharing. Bad outcomes obviously can result if highly sensitive data fall into the wrong hands. Government organizations that collect and maintain the data have well-established and time-tested security measures already in place. Taking the data outside the sphere of these protective measures could potentially introduce grave risks. The remedy for this obstacle is that data sharing must occur with controls and safeguards every bit as rigorous as the ones that the sources of the data have employed and refined and tested over time. To share data, regulators must work out legal agreements and to determine the technology and standards for use for exchanging the data. Now is the time for agencies to work through the legal and the technological issues. In contrast, during times of crisis, we will have neither the latitude nor the time to ensure that we can share data safely and quickly when they are most needed. At the OFR, we're committed to protocols and procedures for collecting, storing, and appropriately sharing data that meet or exceed the strict standards of our data sharing partners. In fact, the OFR has developed world-class data security procedures, and we have defined and adopted a data security classification scheme and matching controls to assure secure data handling and sharing. Using them, supervisors can know that their data are just as secure with us as they are in their own systems. We've also sponsored exploratory research and discussions on the use of new tools, such as those involving cryptology to protect data. and we're routinely communicating with providers of information about how to anonymize it to ensure that confidentiality is protected, whether information is viewed in isolation or in combination with other information. Through bilateral sharing agreements among FSOC member agencies, all participants can be assured that shared data will be protected, secured, and treated consistently. We are already sharing data under such agreements. Examples include our access to the Securities and Exchange Commission's detailed data about hedge funds and other private funds in Form PF, and their detailed money market fund data in Form NMFP. Using the Form PF data, the OFR is evaluating leverage across different hedge fund strategies with a particular interest in sources of leverage, and we're collaborating with other agencies like the SEC in doing that analysis. As we all know, sharing alone will not fill all the data gaps we need to form a complete picture of the financial system. We must also fill gaps by collecting new data from firms and markets. Our partnership with the Federal Reserve to fill gaps in data describing repurchase agreements, or repos, is a good example of such initiatives. In October, we announced a pilot project to understand how to fill those gaps, and today that project is well underway. As you know, a repo is essentially a collateralized loan, when one party sells a security to another party with an agreement to repurchase it later at an agreed-upon price. Repos are an important source of short-term funding for the financial system. The U.S. repo market provides an estimated $3.8 trillion in daily funding. However, the repo market can also contribute to threats to financial stability. The U.S. repo market is comprised of two parts: the tri-party repo market, in which transactions are centrally cleared by two large clearing banks, and the bilateral, or DVP market, where repo transactions are cleared and settled privately between two firms. Information and data on the tri-party market are published regularly, but the information about bilateral repos is scant. Our project is designed to fill the gaps in bilateral repo data, and it marks the first time that the OFR is going directly to industry to collect financial market information. Participation in this pilot project is voluntary, and participating companies have provided input on what data should be gathered and what templates should be used for collecting the data. This pilot is intended to inform future collection efforts, which we hope to initiate quickly. Aggregated data from the pilot will be published to provide greater transparency into the bilateral repo market for the benefit of participants and policymakers. So let me sum up. Promoting data standards and filling data gaps are core elements of the OFR mission. Without good data, we can't do good research and provide the good analysis needed by policymakers to protect, to assess, and to monitor threats to financial stability, to protect financial stability and to assess and monitor the threats to it. Lacking good data, firms will have much more difficulty assessing and managing their risks. Your collaboration is an essential ingredient in making good data available to all of us. Thank you again for the opportunity to join you here today. I'll be happy to respond to a few questions.
So I'll start with a quick question, and then we'll open it up to the group. Is this on? I'll start with a quick question, then we'll open it up to the group. But in the wake of the financial crisis, LEI had some clear international political weight behind it to address that problem. I wonder if you could talk a little bit more about how you're balancing kind of trying to drive global standards with things like financial instruments versus doing them here in the U.S., and what kind of the roadmap is you see for standardizing things like description of financial instruments at a global level in the coming years.
Thanks, Bryce. That's a good question, because obviously we live in a world where markets and institutions are global. So if we apply standards in one part of the world and there are different standards used in another part of the world, then that may create opportunities for being confused about information. Not having standardization, really does limit the benefits of the use of a particular system. But I think the good news lies in two areas. One, as I alluded to, all these systems are like networks. So there may be upfront costs and in getting them started, which are typically borne by the largest and most complex institutions. And as the network benefits start to accumulate, and as the costs of putting the system in place start to decline, then others will jump on board simply to realize and benefit from that network system. And so it's very important to think about how we sequence the introduction of standards, starting with the largest and most complex institutions and working our way through the system. The second thing is that while it would obviously be desirable to have one standard across the world, for example, for entity identification, that ideal may not exist or may not come to pass immediately. So it's incumbent on us to develop ways to crosswalk across different identification systems. They can coexist. And as I implied in my remarks, when it comes to instruments and products, we don't want to disintermediate people who already have a vested interest in those things. But what we do want to make sure of is that they can talk to one another and they can coexist with new standards. And let the marketplace decide, which system is best. There's obviously a collective action issue here. Sometimes the marketplace, because of externalities, has difficulty deciding, and that's where government comes in. But I think, as the industry collaborates with us and participates with us, we're going to find out where the best systems are and where the best identification systems work. So that happens both within the United States and across borders. And that's our experience from the LAI, and we hope it will be so with instruments and products as well.
Thanks. Should we open it up to the floor?
Thanks so much for your remarks, Mr. Berner. Lisa Garcia, FOIA Resource Center. Really, my question is more about Bitcoin. Does this fit into that at all, or how do you see that kind of joining into this world?
I'm sorry, could you repeat the question?
I'm sorry, Bitcoin. I spoke too loudly. Bitcoin, how do you see them coming into this world?
Okay. Well, I'm not an expert on Bitcoin, so I really can't really speak to that. But, more broadly, financial innovation is a fact of life. It's a constant. It will always be with us. New methods of payment are always going to be with us. And so, as I alluded to in my remarks, we're never going to be able to keep pace with financial innovation, or much less get ahead of it. I think what's important is that we recognize that we need to move in the same direction that, if you will, the financial puck is going. We need to anticipate as best we can new innovations, what they mean for the rest of the financial system, how they interact with the rest of the financial system. And if a particular innovation is a viable one, then it would be great that there's transparency in that innovation, that people understand who's transacting with whom, who owns what, as I implied earlier, and how that system interacts with the rest of the financial system. Data standards, I think, can help us in achieving that.
I'm going to take the microphone wielder's prerogative. Part of the OFR's mandate for data standards is to reduce the regulatory reporting burden on the entities that are required to report to any of the 9 agencies that are members of the Financial Stability Oversight Council. We've seen that concept taken much further in other jurisdictions. For example, Australia, Belgium, the Netherlands have all adopted standard business reporting, in which separate agencies adopt consistent data standards in order to allow entities to report once, and the information automatically flows to whoever's supposed to receive it. Do you see any U.S. financial regulators being willing to outsource their reporting functions in that matter? What sorts of policy changes do you think might bring us to that point where other countries have already gone?
Well, it's a great question, Hudson, because we have a very different regulatory structure and a more complicated and broader financial system than some of the countries that you named. So they've got an easier job of it. And we have a legacy that we inherited of a very diverse, shall we say, financial regulatory structure, and quite frankly, a much more diverse financial system. And my hope is that when people see the benefits of using single standards for obvious purposes like entity identification, that it will quickly become the gold standard for such purposes. That over time, the costs of adoption of changing systems, which are legitimate, will give way to the obvious benefits of having a single reporting system. So we need to use incentives in the marketplace to make that happen. The cost of acquiring an LEI is really very small. The cost of putting in place new systems is a one-time upfront cost. Once that's done, you can start realizing the benefits. I think the regulators are starting to recognize that what we've been saying for the past 4 years is really coming to pass. That if we can precisely identify parties to a financial transaction, and just as important, precisely identify the instruments that we're talking about. Because often duplication in data collection relates to a misunderstanding of exactly what people need. When we can do those two things, we have a much better shot at harmonizing the kind of regulatory reporting that we all aspire to.
Thank you. I'll go around to the back.
Any other questions?
There are a couple in the back.
Hi, Dick. Michael Donnelly.
Hi, Michael.
The Clearinghouse. Good to see you again. Just following up on that, does the Federal Reserve's NPR about requiring the use of LEI, but only if the institution already has an LEI, does that go far enough, or would you like to see them require institutions to get LEIs?
That's a great question, Michael, because it illustrates the point that while U.S. regulators, I think, are generally on board with the principle of adopting the use of a standard identification system, they need to take it much further. So, as you point out, if people already have an LEI, then the reg requires that they use it. But we would like to see broader adoption of the system across banking and other types of financial companies. We also recognize that for larger and more complicated financial companies, that's probably where the adoption is appropriate first. For the simpler, smaller, less complex companies, they will hop on the system when the network benefits become more obvious to them.
Hi, Dr. Berner. Tim Lee with FI Consulting. A more long-term strategic question, if I could. We're obviously all trying to head to a point here where financial reporting, financial data becomes more immediate, more real-time, more transparent. And having worked in the financial markets, I can see a certain hubris developing where the financial crisis, I think, was largely a result of tightly coupled systems combined with a lack of information. And I can see people saying, well, now that the information is more readily available, we can make the financial systems more tightly wound again. And do you think the financial regulatory community should be thinking ahead to how do we set fire breaks? How do we reconcile this availability of information with this need to prevent some hiccup from flowing through the entire system quickly? Or do you think the flow of information, the better flow of information itself, is going to guard against that?
Well, I really like your question because it points up the fact that while I stressed in my talk the need for great data to make good policy decisions to help manage risks, that's necessary but not sufficient. You obviously need good processes, good judgment, good governance. All those things are required to have effective risk management, both at the micro level, at the firm level, and from what we like to call macro-prudential perspective across the financial system. And that requires a lot more work. So hopefully having good data won't give people comfort that they can be casual and insouciant about risks. Because if anything, financial innovation, and a variety of other factors means that risks are still out there, and we need to be watchful and vigilant in assessing and in monitoring those risks.
I wonder to what extent our sanctions regime in foreign policy, which is becoming increasingly important, could help drive this agenda. In particular, say the Republicans are going to possibly introduce legislation to dramatically expand sanctions in regard to Iran. Much of that has to do with banking entities and tracking entities all over. Maybe that's an opportunity to explore much more complex ontologies of legal identifiers, because you have all these links between legal entities that have been very hard to track. Maybe this could be a vehicle, a politically viable vehicle, to implement at an international level some of the more ambitious part of this agenda, especially in linking legal entities across, international markets. Is that a possibility?
I'm not a sanctions guy. I'm not responsible for doing any of that, so I'm not going to answer that question directly. But what I would say is that when we talk to large, complex global financial institutions, they point out to us that the use of the LEI on a comprehensive basis will help them with their money laundering requirements, with their know your customer requirements, with your standardized settlement requirements. And so I'm very sympathetic to, I think, the thrust of your question, which is broadly that risk arises in a variety of circumstances and situations and jurisdictions. And in order to understand better the nature of those risks, if we have better quality data, then that'll give us a leg up.
Okay, any other questions? Hudson, right behind you.
Hey, Daniel Castro with the Center for Data Innovation. Thanks for your talk about the vision for financial data. I was just wondering if you could kind of put into terms of what's the timeline that you see for kind of what's an aggressive timeline that you would see for ubiquitous adoption of this kind of vision? And is there anything that you think the federal government really needs to do or could do to accelerate that?
Well, if we broadly include the federal government as inclusive of the financial regulatory community, I think the answer to that is pretty obvious. More broad-based adoption of standards, entity identification standards which are now available, and when they are available, identifiers for products and for instruments, that's really going to help. And that will help solve that collective action problem that I referred to earlier. And I think industry really wants that. They don't want to have multiple systems, in the long run. Obviously, there's an upfront cost to changing things, but I think that everyone in the industry has told us, and trade groups are very supportive of the idea that, let's just bite the bullet and get on with it and settle on that system that's going to help us all manage risk better. Thanks very much.